Hello, everyone. This is I guess I do this webinar whenever I feel like I to do. So I had a request about, syndication and real estate investment. And one of our group member, Dr. Mitroo, is a syndicator. That's what they call for a while. So we've been knowing each other for a couple of years, probably. So gratefully, Dr. Mitroo agreed to come on our group and then give this talk. So today's talk is about real estate syndication, passive investment in multifamily. Dr. Mitroo is a gastroenterologist, and she also is a founder and CEO at Prismic Capital. That's her investment company, and she has been investing in real estate since 2005. So we're gonna chatting right before, but she has a extensive experience and wealth of knowledge, and she's gonna give a little quick, it's not quick, but some presentation about syndication. Go ahead, Dr. Mitroo.
Thank you, Sujan. Thank you for inviting me. I got started in real estate in 2005, originally, as Sujan said, as a little bit accidental landlord. I bought a property during fellowship and then rented it out when I didn't need it and realized the tax benefits of real estate. And that's kind of how we started investing in real estate. We moved to California in 2007. And then when the market went down, we were investing in single family and short-term rentals up until 2016, when I became more involved in multifamily. So you know what, I'll share my screen. Oh, can I share my screen or are you gonna show the presentation?
I will make you as a host. Okay, go ahead. You should be able to share now.
So basically, today's talk, we thought it was good to go over what are syndications, why should you consider it, and how to get started. But I thought I'd like to talk a little bit about my journey and, real estate in general. So like I said, I started in single family and short-term rentals. In 2015, beginning of 2016, when I was getting divorced, I realized that I couldn't really do things as actively as I was at that point, and started looking for things to invest in passively. And that's when I found multifamily. And at that point, I started investing passively in multifamily syndications, basically apartment complexes. And over time, as I was selling other property, got more involved in it, mainly because of the tax advantages. So in 2016, I was selling a lot of property. I couldn't 1031 everything. By 2017, there was something called bonus depreciation, which I'll talk about, and actually ended up just putting a lot of that into multifamily and using that depreciation, so I wouldn't have to pay as much taxes while selling that property. So why invest in real estate? So biggest thing is build wealth as opposed to building income. So most of us W-2 jobs are just building income, work more and more, try to build more income. But that's, to me, it's, what we want to look to is financial freedom and building wealth. And it's important to figure out what you want to invest in, what your investment strategy is going to be to build wealth. For me, that was real estate, and now, real estate syndications. So when I was looking at what things I wanted to invest in passively, I looked at lots of different asset classes, but I ended up picking apartments because they historically have done well through many downturns. So they did well in 2008, 2009, when the economy was crashing and single families properties really went down in value. They still did well through COVID. And in general, if you go through historically, apartments have done well because, especially if you look at workforce housing, because most of those people tend to rent for their entire life. So how does real estate help you build wealth? Number one is cash flow. So that's your passive income. The tax benefits are huge, and especially for physicians who are overall high earners, we really don't have a lot of tax benefits. Everything is open. We're paying a lot of taxes on everything that we earn. Real estate really can help you earn tax efficient income. Appreciation. So historically, even though real estate goes down at certain times during recessions and things like that, overall it goes up. It almost always appreciates, and then it gets you to your financial freedom. So where I love what I do. I'm a gastroenterologist. I'm in a private practice. It gives me autonomy to work as much as I want. At this point, I'm working 3.5 days a week. And I still love what I do. So the biggest thing is, if you're just, trading time for money, over time, you just get burnt out and don't enjoy what you do anymore. I want to be able to work for as long as I want, but work on my time and with autonomy. And real estate really allows me to do that. So at this point, I have enough passive income that I don't need to work full time. So again, talking about these tax benefits of real estate, it's one of the biggest things is depreciation. So depreciation is a concept where property owners are allowed to expense a portion of the investment property's value each year to account for its deterioration. This is really important. In general, there's something called straight line depreciation, which is over 27.5 years. You can depreciate it, and that you actually take as a loss each year. And that can offset the income that you're getting from your properties. And that's really important because that allows your income to be really tax efficient, which we don't have in any other vehicle. There's something called bonus depreciation, which started in 2017 that I was talking about earlier, which part of it is where you can actually take all the depreciation, which you would have got over that entire period of time, and actually take it in the first year. So say the property value was 100,000, you were going to get a depreciation over that period of time of about 40, 50,000. You can take that entire amount in the first year. Now, one of the reasons why multifamily is really nice is because you can actually get a lot of depreciation in multifamily because these properties are so large. You can actually do something called a cost segregation study. So the cost segregation study is where appreciate pretty much every single thing that's available in that property, every appliance, everything but the land basically that it's on. And when you do that, it really increases how much you can depreciate, because now you're depreciating your dishwasher, you're depreciating the microwave, all these things. And if you're talking about 200, 300 unit property, that's a lot of appliance, a lot of stuff in there that you can depreciate. So the depreciation for these large multifamilies actually ends up being much more than you would ever get for a single family. And that's really, really helpful. So as I was talking about before, I think, most people know about a 1031 exchange, which is where if you're selling a property, whatever money you make from that, you would have to pay capital gains on it. So to avoid paying capital gains, you can actually take that entire amount and put it into another property. But when you're doing that, if you have a loan on that property, it has to be the entire amount, including the loan. And so, and there's restrictions. You have to identify the property within 45 days of selling your property. You have 90 days to close. So after my divorce, when I was trying to figure out what I was going to do, some of the properties that we were selling, I couldn't 1031 because some of them were getting divided up. And so I had to find a better tax efficient way of doing that. And so this was ideal for me. Basically, if I was taking 100,000 and putting it in this multifamily, my bonus depreciation with everything was coming out to about 95,000. So essentially almost all of what I put in there, I was actually getting back as a loss. So I really ended up not paying any taxes on anything that I sold at that point, which I would have had to do if I was 1031 it at that time. So because I wasn't able to 1031. So this is just a little, graphic on benefits of real estate compared to other modes that you can save in. So you can see in terms of cash return, real estate has a really good cash return. Stocks, yes, they have tax return. Bonds, a little bit. Cash, really no cash on cash return. Equity buildup, yes, real estate and stocks have equity buildup, bonds, no, cash, no. Real estate is a hard asset. And that's really huge when it comes to, especially a time like right now with inflation. So with a hard asset, with inflation, as inflation goes up, the prices most of the times tend to go up as well. And it's really a hedge against inflation, having a hard asset. Stocks don't have that. In fact, when interest rates start going up, as you see now, and inflation is going up, people are scared. And it's really mainly about mindset, and stocks can go down quite a bit. Same with bonds. Tax benefits, real estate has significant tax benefits that we just talked about. Stocks don't really have that. And so, you will end up paying capital gains on the stocks. Again, like I said, real estate is an inflation hedge. Stocks maybe, depending on what you're investing in. Bonds are not. Cash obviously is not. One of the huge things about real estate also is using leverage. Because you're able to get loans for these properties, it really allows you to get a great cash flow and a good return on these properties, because you're using the bank and really leveraging that. In stocks, well, you could do that if you're using certain terms. And when you look at the returns, overall, real estate does really well in terms of returns long term. So average annual return is between 14 to 16%. Stocks maybe 7 to 9. Stock market's done really well over the last few years, but now you can see, it's very volatile. Volatility is the biggest problem with the stock market. Whereas real estate overall, if you look across the board, most of the times real estate has gone up. It may have a little bit where it bumps down, but it always then goes up. It goes up and up. So almost always you see appreciation in real estate, and obviously not in cash and savings. So here are the pros and cons. Paper assets like stocks and bonds, the biggest pro is it's very liquid. I can say, hey, I need that money like now, and go and sell my stocks, and I have that money. It's in my account. I can do whatever I want with it. It's easy to invest. I just go onto my Ameritrade account or whatever and buy whatever I want. There's less money needed. You can put in $1,000 and daily put in whatever you want, and you're able to diversify quite a bit very, very easily in stocks and bonds, because there's so many different vehicles that are available to you. The cons are, like I was saying, it's volatile. It can go up and down. A lot of it is related to what other people are doing, as we saw with a lot of stocks over the last year or two. Lack of control, because a lot of this is, again, related to what a lot of hedge funds are doing. When the hedge funds managers decide to change something, that affects the stock market. You have no control over that. And the biggest thing is it's not tax efficient. For most of us, our biggest expense is taxes every year. And we really, really need to be investing in something that's tax efficient. So real estate really helps with that, whether you're doing single family, short-term rentals, multifamily, whatever it is. Overall, real estate tends to be very tax efficient. Now, the pros for hard assets is that it's a real asset. It's always a hedge against inflation. You have, more control because you know exactly what you're going to invest in. If you're investing in single family, you have a significant amount of control, because especially these days when prices are going up, it's almost very liquid. You can say I'm selling it and be able to sell it within a short period of time, and it's overall pretty liquid. It uses leverage, which is huge, because you can use the bank's money to be able to make cash flow and the tax advantages. Now, the cons are, in general, it's illiquid, especially syndications, because you're actually investing with somebody. And even if you're a general partner, you're still investing in this property, and you can't really get your money out until you sell that property, which most multifamily investments are usually about 3 to 5 years. There's usually a higher transaction cost with it, because there's closing costs with real estate and things like that. And one of the other things is there's more work and education required. So with the stock market, well, you could say I'm just going to put it in a fund and forget about it, and it'll just keep going into this fund. Whereas here, you have to do your due diligence. You have to figure out what markets you're going to invest in. If it's single family, what markets, where what kind of loan you're going to get, all those things. You really have to understand that. In multifamily, you have to vet the sponsor, know which market you're going to invest. So there's education definitely required when you're investing in real estate, whether it's single family or multifamily. So here are the different types of real estate investments. So, most people in general end up starting with individual investments like I did, single family, short-term rentals, mid-term rentals, where you personally own and manage the property. I mean, you may have a hired management, or they may be turnkey properties, which has been pretty big over the last 10 years or so, where there are companies that they have houses that they bought. They may be single family or small multifamily that they rehab. So you don't have to do that work, and then you buy it from them, and then they help you manage it. So that can be kind of passive, but you own it yourself. There are syndications, which can be syndications basically are where multiple people pool their money to buy real estate. So there are different asset classes, not just apartment complexes. So there's self-storage syndications, there's triple net syndications. That's commercial real estate. Basically, there are multiple different ways that there are syndications that people can invest in. There are crowdfunding platforms like CrowdStreet, Realty Mogul, stuff like that, which people can invest in. Those you have to be careful because it's not, there's a lot of people that are just putting stuff on those platforms. You really have to do your due diligence and know who they are and understand what they're doing. Otherwise, you can easily lose money there. But one of the advantages of crowdfunding is that you can put in smaller amounts. So some of them can even be like $5,000 or $10,000, whereas most syndications are usually $50,000 and up. Another way to invest in real estate passively is individual REITs, which are essentially like buying stocks. The issue with buying REITs is that they're owned usually by these big fund managers, and they buy these big multifamily properties, and they don't really care that much about cash flow. So they're not really doing a lot to these properties. They just buy them, whatever cash flow comes in, it comes in. So you're not really getting the best bang for the buck when you're investing in these REITs. In fact, I know that because we bought a few of our multifamily properties from these REITs. And usually there's a lot that we can do to these properties in terms of rehabbing them, even sometimes just bringing up the rents to market without even doing anything, because most of the times they're not really well managed. They don't have their own property management. And then there's REIT mutual funds. So basically the REITs in a mutual fund that you can invest in. So what is a syndication? Like I was saying earlier, basically a real estate syndication is when a group of investors pool together the capital to buy a large asset. Now, like I said, most commonly it's multifamily, which are large apartment complexes. So usually that's like 60 and up. And sometimes it can even be a syndication for a portfolio of properties. I did one that was about 1,200 units in 4 different markets. And it was a portfolio of these multiple properties. So people pool their money together essentially to get the down payment, if you call it that, just like with a single family. And then the rest comes from the bank. So this is really a team approach because as I was talking to Sujan earlier, it's very different animal from single family because there's so many different things that are involved when it comes to especially a multifamily syndication. And I'm really only going to talk about multifamily because that's my experience. And like I said earlier, I chose multifamily because it's done the best in terms of asset class historically compared to any other commercial real estate. Who are the people involved in a real estate syndication? There's the real estate broker. So the broker actually is the one that brings you the deal, kind of just like a real estate agent in a single family. So it's really important that if you're planning on being a general partner who's actually buying the property, that you have really good broker relations, because especially these days when the prices have gone up so much, you really want an off-market deal to make the numbers work. By the time it comes on market, it's already more expensive, and there's a lot more competition to it. So if you have good relationships, the brokers will actually say, hey, I have this client of mine that has been a client for a while and just wants to get this done really quickly. And if they know you can close that property on time, they'll bring you this deal off market. The lender is huge because that's actually the biggest partner in the whole thing. the general partners. So general partners are essentially people who are the ones that find the property and then put in a certain amount of money and then raise the capital to do the down payment. So essentially, say I have this property in Houston that I want to syndicate. I get partners that I trust, that I work with all the time, who have a lot of experience. And then we have to put a certain amount of money in for the down payment ourselves. Usually it's between 1 and 1.5% of whatever the raise is going to be. And then the rest of the money we actually raise from our investors to make that down payment. And then, like I said, the largest partner in the whole thing is actually the lender, because usually at least 70%, now it's down to 65% sometimes just with the environment. But a large portion of the money is actually coming from the lender, which is actually good in many ways for investors, especially passive investors, because the lender is very careful about doing their due diligence. They don't want to invest in just anything. They have a lot of money and invest in these properties. They actually come with you to the due diligence. They do their own due diligence. You have to hand a lot of different paperwork that they need. And if they feel that what you think you're paying is not worth it, they'll come back to you and say, hey, we don't think it's worth this much. Even if the appraisal says it's worth this much. So you need to go back to the seller and say, hey, I'm not going to buy it for this much. And so in a way, that's actually, a really good backup and safety net for passive investors in these large multifamily deals, because the lender usually is very, very careful about what they're investing in. The key principals are usually people with experience that come onto the team to help with the lending and things like that. And then, of course, there's the passive investors who don't sign on the loan mainly and don't really have to deal with the brokers, finding the lenders, all those things. So the general partners work on that. The broker brings them the deal. They find the lender. They put together the capital, get all the due diligence done on the property. So due diligence is just another way of saying inspection of the property. So for single family, it would be an inspection. For large multifamily, we call it due diligence, because there's so many more factors that are involved and so many people that are involved in it. And then another part of the team is the property manager. So property management is really a big key in terms of what your cash flow is going to be in some of these deals. So if you have a great property management company, or if you have you're very experienced and have multiple properties that you use the same property management for, you can actually get about, they'll charge you 1 to 3% for property management, which is huge. Or if you have in-house property management, even better. So it's really economies of scale. And so property management has to be really good. You have an asset manager, which is one of the general partners usually, who's looking over the property manager and saying, hey, we need to make sure we bump up the rents, make sure we're doing all the rehab and everything that needs to be done. But the property manager is a big part of the team as well. So essentially, general partners put the deal together, get the lender, and then present it to their investors. Say, hey, this is a great deal that we have. Are you interested in investing? And then when interested, they invest in that. All together, we put together the capital and make that down payment to close. And then essentially the property manager comes in and starts doing the work the next day. So most of these multifamily properties we call value add. So there are development deals as well, where you actually are building these things from ground up. I personally don't do many development deals. I just find that it's riskier. I like the value add because you are essentially you can already see what the property has done. There's already cash flow most of the times when you're buying the property. And your job is just to go in there, fix it up, bump up the rents to market value, and then, have the cash flow coming in. And one of the important things in multifamily is that the values of commercial real estate, especially multifamily, is based on the income that it's bringing in. This is really important to note because it's very, very different from single family. Single family, the value of the property is based on the comparables around it. Whereas for multifamily, it's really based on the income of the property. And so that's why this doesn't get affected as much when it comes to recessions and things like that, because renters are still going to be renters. They're still paying their rent, and the income is still coming in. Because the income is still coming in, the property values are continuing to go up. And we're seeing this now, because as people are having to bring down the values, as single family values are coming down, multifamily values are still going up currently because rents are still going up. There was about a 13% increase in rent this year, just in 2022. There was a 17% increase in rents last year in 2021. So, so since income is still going up, I think this is still a great asset class to continue to invest in. So basically, how does it work? You buy the property, we do something called force appreciation. So force appreciation basically means doing the rehab. And usually when we're buying the property, we've already decided how much rehab we're going to do. And a lot of that is already written in to what we think the expenses are going to be. And that's all accounted for already. So people ask me that all the time. Well, you have to renovate all these units. So is that going to take away from the income? No, because the income that we project is usually based on already taking into account what we call capital expenditures, which are the renovations. And most of the times, the bank is actually giving you money for that. And in fact, they check on that. Every certain amount of time, you have to do a certain amount of rehab. Like I have a property in Houston that I bought with my partners last July. And so within the year, there was a certain amount that we had to spend or we would lose it. So there was a certain amount of rehab we had to do. Usually the way it's done is, as the lease comes up and people move out, you renovate that particular unit and then you bump up the rents and then you move on to the next one. So most of the times you're not doing all of them at the same time. You're doing them as they come up. And you base your budget based on that. But the lenders actually require you to use a certain amount during a period of time because they want to make sure that you're going with the business plan that you had already discussed with them. And then that way they know that when it comes time to refinancing or selling, that property is going to be worth what you said, what you had projected that it was going to be worth at that period of time. So the timeline is actually very important. Most of the times, these properties get refinanced in 3 years, and then most of the time sold in 3 years. And then there's cash flow along the way. So as the income comes in after the expenses, usually all that is then distributed to the passive investors and the general partners. So, and it's very important to know that, all the general partners have to have skin in the game. It used to be in the old days that a lot of times they didn't put much money in, they just brought in money from the investors and bought these properties, but the lenders will not allow that because they realize that was happening. And if the operators did not have skin in the game, then, they were not going to keep up with their business plan. So at this point, almost all the lenders require at least 1% to 1.5% of whatever the capital raising is going to be to come from the general partners. So everybody has to have some skin in the game. So important things to vet when you're looking at these deals. The most important is the sponsor, how many deals they've done, how much experience they have, how many have gone full cycle. So full cycle basically means that they refinanced and then already sold. So the last couple of years, there have been many properties that have gone full cycle within 2 years, because a lot of times, if the properties were able to be sold and able to get the returns that were projected in 5 years, a lot of the general partners actually, or sponsors, ended up selling the properties and returning the money to the investors, and then moving on to bigger units. The property is really important. So here is the class of property. So there's class A, B, and C, and then there's D, which you really don't want to get involved in. So class A are usually white collar workers, really luxury units. And in the past, people didn't really want to, not a lot of people did them as much. Recently, there are more people feeling like there's still a good cash flow from, because in the past there used to not be as much cash flow in class A, they felt there was more cash flow now, because there are a lot of people, even with high income, that have decided not to buy homes or feel it's too expensive, that are renting. So, it's been doing some cash flow. I personally invest only in Class B and Class C. So Class B are usually white collar workers still, but like nurses, doctors, and then usually Class C is more workforce housing. It's usually more blue collar workers. Class C is nice because almost all the time that workforce housing ends up always renting. They almost never end up buying. So they're essentially lifetime renters, and they're probably going to be in those properties forever. So I find B and C class is less risky. And so most of the times I invest in that, because even if there's a downturn in the market, in there's a recession, their Class A will move to Class B, Class C, well, most of the times Bs are moving to Cs and filling it up, and then most Class Cs just end up staying there. Especially right now, we notice that as the leases come up and we bump up the rents, some of them will say, well, I'm going to look around, but then they come and take it, because you look around, everything is even higher. So that's important. So location of property is really important here, because you want to be in an area where that's the case, where the comps are good, and so where people are moving in, and there's a demand. Because otherwise, if there's no demand, then those people could say, hey, there's a property down the way that's, I'm not going to take this rent bump. I'm going to move to this other property. So it's really important, the location of the property, and then the condition of the property, obviously, because you don't want too many expenses that you hadn't accounted for in your due diligence. And then, like I was talking about the market. So where is the population growth and where is the rent growth? That's really, really important when you're deciding what you're going to invest in. So for me, one of the first things that I looked at when I was doing any of these deals was the market. And Texas was the market that I originally focused on. That's actually where I have most of my partners. I have boots on the ground, and that is a very, very fast growing market. Dallas, Houston, Austin, all of those areas. Currently, there's still so many companies moving into Houston and Dallas. A lot of them moving from the Bay Area here to Dallas and Houston. Microsoft just opened up a huge office in Houston. And if you look on all CBRE and all these commercial real estate, you can see the huge amount of rent growth that's projected to happen in these areas, because the population growth is there. So it's really important to look at these things. So currently the biggest markets are Texas, Dallas, as I said, Houston, Austin, Florida is really big, Tampa, and Orlando and Miami. In Tennessee, Nashville is really fast growing. The Carolinas, North Carolina, Greenville, South Carolina, those are big markets, and Phoenix is huge. So Las Vegas was in there, but prices have gone up so high, and right now there's not as much population growth happening there. It happened over the last year or two, but population growth has kind of stabilized in those areas. So right now it's mostly Texas, Nashville, the Carolinas, and Florida are the big markets, and Phoenix is still booming. Phoenix, Tucson, those areas in Arizona. So these are, I thought actually I could just go over a few terms that I use when you look at different multifamily. So when you are looking at an investment summary that comes up for a multifamily deal, a lot of times you'll see, basically in terms of your returns, you're going to see something called an IRR, cash flow, equity multiple. So, basically what does that mean? So I'll start actually with the IRR. So the IRR is the internal rate of return. So the rate of return is, it estimates the annual rate of growth that investment that you put the money in is going to generate. And there's a big, long formula to it. But basically it takes into account the time value of that money. So the amount of time that it's in there. So basically the higher the internal rate of return, the more desirable the investment. Basically, the most important thing is it allows you to be able to easily compare two investments. And IRR is not only used in multifamily, it's used over multiple asset classes. So you can actually use the IRR to actually compare your investments in other asset classes. So say you're deciding, oh, am I going to invest in this multifamily syndication versus a syndication of a triple net property, and the IRR is 10 in one and 15 in the other. Well, even though they're completely different asset classes, you can compare these two now because you're using this formula to generate it over, it accounts for the return as well as the time. And you can say, hey, the 15% is way better than the 10% and go with one or the other. So it's good in terms of that. As opposed to a return on investments. People will talk about return on investments a lot. This is not talked about as much with multifamily, but you talk about it a lot when you're talking about single family. So basically, the return on investment is the difference between the net gains from investing in the property less the net cost divided by the actual purchase price of the property. And usually that's reported as a percentage. Cash on cash return. So again, not used as much in multifamily, because in multifamily, we just usually tell people what the cash flow is going to be and what the internal rate of return is going to be. But basically, this is the cash on cash return. You can look at it as the annual cash flow that you're getting over the total cash that you invested. And that tells you what your cash on cash return is. Again, another good way to compare investments. Cash on cash in one investment versus cash on cash in another investment. One of the important terms in multifamily is the cap rate. And we talked about the net operating income earlier. So the net operating income is actually the income that's generated after deducting the operating expenses, before deducting taxes and financial expenses. So you take out only the operating expenses. So say my property earned me $10,000, and with the rehab and stuff like that I had to do, I ended up using $5,000. So that's my net operating income was $5,000. It doesn't take into account any depreciation that you may be able to write off, or the debt service, which is the amount of loan that you're paying. So that's not included in that. And the net operating income is important because it helps determine something called a cap rate. So the cap rate is not as important in single family, but it's really important in multifamily. And the reason why it's important is because when you're assessing an investment, you really need to look at what the cap rate was when the property is bought and what they're predicting the cap rate will be when they make their assumptions and tell you what they're going to give you back, because you want to make sure there's a good spread between those. So if the cap rate now is 4%, and then they're telling you they're going to be selling this property and the cap rate is going to be 3.5%, it's very unlikely for that to be the case. And so you always want to account that the cap rate is actually going to be more, which means that maybe the property value may be less, and you want to make sure that they've accounted for that when they tell you what the returns are going to be. So basically, the cap rate is the initial return from the acquisition of the asset, and and divided by the net operating income. So the example actually helps tell. So basically, the cap rate is 10%. So say you purchase a property for $10 million, and it gives you $1 million net operating income in the first year. So basically, you're dividing the 10 million by the net operating income, which is the cap rate, which is about 10%. And so if the net income is changing, then that's really important to know that. So the cap rate is important for when you're evaluating the deal. So you want to make sure that they are very conservative in what we call the exit cap rate, is what is the cap rate when you're actually selling the property. So I'll go back here to what usually an investment summary looks like. So in the investment summary, they'll tell you what the internal rate of return will be, and most of the times it ends up being about 12 to 15%. Now sometimes can be a little bit lower. It just depends on the cash flow, what your debt service is going to be, how much loan you're getting. But you want to look for between 15 to 16%. In the last couple of years, most of the properties that I've invested in on full cycle on, the IRR has actually, even though they predicted about 15 to 16%, it's been between 20 to 25%. So they've actually done really well. Cash flow, they'll tell you between 7 to 8%. Equity multiple is really important. So it's funny, one of the sponsors that I work with, one of the larger operators, always jokes about this when he says, well, you can't eat an IRR, but the equity multiple is really telling you what it means. So the equity multiple, to me, is actually the easiest to understand. So basically it means that whatever money you put in, when you exit the property and you sell the property, that's going to be about 2.8 times. So say if the equity multiple is 2.8 times what you put in there. So if you put in 100,000, you should get about 280,000 back. So, and then for most of these, the minimum investment is about 50K. Some of them could be 75 or 100. And then there's something called an equity split at the end, which is also what you need to look at. So, so when you invested in this property, as the income starts coming in, you're doing distributions and you're getting a distribution. So either monthly or quarterly, you're getting some money that's just getting distributed into your account. And so that's basically your income coming in. And then at the end of it, when the property is sold, it's divided up amongst the limited partners and the general partners. So 80%, either 80% goes to the limited partners, 20% to the general partners. Sometimes it could be 70% to the limited partners and 30% to general partners. In some structures, you can have 50-50. Most of the times, if it's 50-50, it's usually because the cash flow that you're getting is a lot higher and you're getting a preferred return. So preferred return basically means that the passive investor gets the money before the general partner takes anything. So say the general partner says, you're going to get a 10% preferred return. That means the limited partner, your investment is going to give you a 10% return before the general partner takes any money out of it. So that may not be that you get 10% in the first year, but on average, over that 5-year period, that you're going to get 10%. Because sometimes in the first year, you may not be able to get all that because you're doing all this expenditure and stuff like that. But then part of it will be made up the second year, part of it will be made up. So on average, you get a 10%. So Jen, did you have a question?
Yeah, so the concepts are really, reviewing the concepts are very important. Yeah. I had a question because when I look at the numbers, I look at the IRR, and then I had an understanding of an equity multiple, kind of a little bit easier way to look at it. But I noticed that depending on what's the holding period is, you have to kind of consider that too, right? So if you think, if they say equity multiple is 2.8, but their holding period is 5 years and versus 3 years, like a less percentage, then you kind of have to factor that in, right? Is that right?
So when we do our projections, we actually will tell our investors what is the equity multiple at 3 years, what is the equity multiple at 5 years. So a lot of times it can be 1.5 at 2 years or 3 years, and then 2 times at 5 years. So usually we divide it up. We'll say at 3 years, it's going to be 1.5. At 5 years, it's going to be 2 times. So that way, so if it gets sold at 3 years, most likely it's going to be 1.5 and not 2. But if it stays for 2 years, it's, but like I said, it's the last few years, it's all these properties have done way more than what was projected. Now we have to see. And so now actually, that's why it's really important to be really careful and vet the deals well and make sure that it's one of the biggest keys is going to be great location. The market is really, really important right now because you have to be in a market where rents are going up. And then the sponsor, and make sure that the sponsor has experienced. But like I said, property management helps. So if they have in-house property management, even better, because it really decreases your costs quite a bit. And so when I usually look at the deals and I underwrite the deals, I want to make sure that there is cash flow. In our program, usually we want at least 7 to 8% cash flow, at least 1.7 times in terms of equity multiple when we're underwriting. Otherwise, it just doesn't work. And so that's why, it's as the prices are going up, you have to be more selective in what properties you bought, because not all the deals work. Yeah, you have to kind of pay attention to that. Yeah.
Do you think the cash flow has been a little bit lowering? I remember they used to, maybe about 2-3 years ago, they're aiming for cash flow like 10%. Do you notice that it's kind of going a little bit lower past year?
Yeah, and I think it's actually going to go even lower, the cash flow.
Oh.
The reason is because of the debt service. So because a big part of the cash flow is what's remaining after you've paid your loan, right? Your loan amounts. And now as lenders are requiring larger, less loan to value ratio. So now it used to be that you could get 80% leverage. Now it's 65% leverage for most of these deals. So as you do that, the cash flow is not going to be as good. So and if people are telling you that they're going to give you 12% cash flow, you really look at the deal really well, because that's not realistic
at this market. Wait, what about the increasing interest rate? I mean, what has been the interest rate for the commercial market? I know the second homes and regular homes, it's like a 5%, 6% at this time. Is it going to decrease the cash flow too? I can assume.
Yeah. So yes, it would. So a lot of times, some of it is as the interest rates have gone up, you have to account for that. So you have to account for it in your underwriting and make sure that the deal is still working. So when you're sitting down to actually write it out, you have to account for as it's going up. A lot of the loans that were done over the last few years were something called bridge debt, right? So bridge debt is not fixed rate debt. It's essentially like an arm in many ways for single family. And but everybody bought you have to buy a rate cap. So if you are looking at doing a deal which is with bridge debt, and it's important to know that, then make sure that a rate cap is bought. Because if there's a rate cap that's bought, then it essentially becomes like a fixed debt, because it can only go so much, and then it's capped at that and can't go up any higher than that. So so that's important to look at. But yes, so right now it's about 4.8 to 5.2% in terms of the interest rates. And many times in many of these deals, literally a week before, the lender will come back and say, we're going to bump it up a little bit more, and we're not going to give you as much money. So you have to account for that in the underwriting ahead of time. And that's, part of the mentorship program that I'm in. We are stress testing these deals all the time. So when we're underwriting these deals, underwriting is basically just the calculations, but it's essentially, for multifamily, it's a big spreadsheet. You have to put everything in there. And when you're looking at them, you have to make sure that you're stress testing it for all the important things. Like, can you, if the rate goes up so much, are you still able to pay it? So, all those things. What if the vacancy goes down? Are you still able to pay the debt? So those things you have to, so vacancy, the interest rate, all those things you have to stress test for. If it's not working out, then you can't do the deal. And so it's really important to, that's why the sponsor is really important. You want a sponsor that really does their due diligence and make sure that they've looked at all those things before they decide to do the deal. And that's why the number one thing is, sponsor and market, because that's going to be very, very important, especially going forward. You really are going to want sponsors that can navigate you through, rougher times, because it's not going to be as easy to make that money as it was a couple of years ago, because everything was just organically going up. Now you really have to force appreciation on these properties. So so I mean, there are still some deals that offer 10% preferred return. So there are some deals that I've done that we offer 10% preferred return, but usually it's with a 50-50 equity split. So the equity multiple is still the same, but it's kind of divided up differently. So it's divided up with a lot of it you get upfront, which is a little bit riskier in many ways. And then you get the rest on the back end. And some of the larger operators will do that. So some operators that will do 50-50, but they're like, with their thing as well, we're going to guarantee you the 2 times equity multiple. So should be okay. So anyway, so what, like we were talking about earlier, the underwriting. So the assumptions are really important. What is the cap rate it was bought at? What is the cap rate at exit? So this is really important because you want this to be very conservative. You want at least 100 base point split. So if it's bought at 4% cap rate, you want to see that the exit cap rate that they're putting in their assumption is 5%. Because if it's lower, it's kind of unrealistic. I mean, if it is lower when you sell it, great, that would be awesome, and you'd make a lot more money. But you want to be on the conservative side and not lose money. So vacancy rates are really important. So we are usually putting in about 10% at least vacancy rate for each year, and more in the first year. So you put more in the first year because in the first year, when new management takes over, you tend to get a little bit more vacancy as people move out, but then it's good in many ways because you can actually rehab those units and rent them out. So actually, like in our Houston property, we had predicted a cash flow of 7 to 8%, but we were able to rehab quite a bit of the units, and actually our cash flow has been up almost 10%. So the market really matters. So you can still get that cash flow, but you want to make sure it's underwritten to conservatively. So we underwrote it's a 7 to 8%, but we gave our investors 10%. That's the better way to go. So you over deliver. And then assumption for rent growth is also very important. Is it realistic? So you don't want to see that people have put in that the rent growth here is going to be 10%. Well, it may not continue to be 10%, even though right now maybe it's 10%. But so usually when I'm underwriting a deal, I usually write for rent growth of at least, usually about 3%, 4% at the most. Even though most markets that I invest in have been at 6 to 7 and even 9% rent growth. So things to think about when investing in 2022. So this is from Bloomberg. U.S. housing affordability is set to drop to 2007 levels this year. So basically, most people can't afford to buy a house. And so most people are renting. More people will be renting. Many will always be renters, like we were talking about before. Inflation will increase asset values because as inflation goes up, these are hard assets, the values are going up. And then again, it's important to invest in markets with growing populations, growing jobs, growing income, because you want renters that are going to be able to pay those bumped up rents that you're assuming in your underwriting. So my investment strategy in 2022 and beyond, work with experienced sponsors and investors who can navigate turbulent times. Diversity is really important to me. So I was talking to Sujan earlier. I do deals 2 different ways, mainly to bring more diversity to my investors. So in the markets like Houston and Dallas, where I have boots on the ground, I have experienced sponsors that I partner with and are in my mentorship program. There, I usually buy the property myself with the partners and bring investors in. In other areas, I want to be able to bring more diversity to my investors, like in Phoenix, Nashville, other places. So there, I actually partner up with larger operators, and we've kind of created a fund that people invest in, and then we invest the entire amount into the property as a large limited partner. And actually, the operators that we worked with are only ones that have had really good returns over the last couple of years, between 20 to 30% IRR. So when I do that, and essentially it's so that my investors can get into different markets and diversify, because diversification is really important. Manage your tax strategy. This is really important because it's all about how much you keep. We spend so much money on taxes, so it's really, really important, how much you keep. And so real estate is a great way of keeping more of what you're earning. And educate yourself. Education is very, very important because there's a lot of things that will come your way in terms of investing, but you want to invest in what is right for you. Different strategies are right for different people. Not everyone, does great with syndications. Some people may still love single family and want to continue to do that. So really you have to look at what your investment strategy is for the long run and decide what asset class is good for you. Do you want to be passive? Do you want to be active? How active do you want to be? Do you want to just be active, in terms of an asset manager where you're just managing the property management, or do you want to actually be the property manager? So all those things are important, and really, unless you educate yourself, it's impossible. So reading books, there's so much available now these days. I mean, in 2005, when we were starting out, there was really nothing, but now there's so much more available. So Kathy, you had a question?
Yeah, I was wondering, in your syndications and funds, are you strictly doing multifamily, or you have diversity of asset class within your fund?
Yeah, no, right now I'm strictly doing multifamily. It's what I know. It's what I feel really comfortable with. I have done some passive investing in triple net syndications, but not as a general partner. Yeah. Because the underwriting is very different for triple nets and.
Oh, definitely.
Yeah. Mm-hmm. Yeah.
I didn't know if you were doing any self-storage stuff.
No, I'm not.
Okay.
Hey, Pradnya.
Oh.
What's a triple net
property?
what is it? Yeah.
Yeah. So triple net properties are commercial properties. So like if you go around, you see big CVS and stuff like that. Those are usually triple net properties where the tenant is actually paying,
Land, mortgage. Yeah.
Mm-hmm. Yep. So and so there's syndications for that. There's syndication for self-storage, like Kathy was mentioning. So there's syndications for industrial as well. Like in our area here in Fresno, there's a lot of industrial properties, and I know people who've syndicated some here. But for me, like I said, when I looked at all the different asset classes and decided what to pick, I picked this asset class because I just felt the most comfortable with it, and I felt it was lower risk than a lot of the other asset classes because it's just done so well over the long run. People are always renting, and people always need housing. Okay, so this is just my information. If anyone wants to learn more, wants to get in contact with me, my website actually has lots of blogs talking about syndications, what each thing entails, about different educational material, and feel free to email me with any questions.
This is great. Thank you so much, Pradnya.
Yeah.
This is
Thanks
what we need in some other groups where they're helping in novice investors and not giving them the tools. You've really provided the tools.
Thank you. Yeah, I mean, that's my goal. I think this has been a great vehicle for me to really be able to scale up. So it's being a little personal. So when my ex and I were investing, our goal was at that time my son went to high school, which was last year, that we would be financial free, and we don't have to work if you don't want. And we were on track for that. But then when I got divorced, all of a sudden I was half of where I needed to be, and I was trying to figure out how I'm going to invest, and I have my kids full time. I don't have that much time, and so that's when I started investing passively. And it's done great. But then, I really enjoy real estate, and I enjoy being involved in at least the asset management part of it and stuff like that. And so I was thinking, what's a good way for me to be able to do that? And that's when I decided, I thought, well, I can just continue in the same asset class and decide to do it. I mean, that said, I still have my midterm rental. I have one short-term rental that I still do, but I've given them to property management. And pretty much I'm, full into multifamily, and so far, it's been great, and I really enjoy like bringing more people into this community that really was not available to the general population, and like until recently. I mean, it was like when he talked about at the country clubs, and
exactly,
people didn't know about it. So,
how many years has it been open more publicly to people? Is it 5 years, or is it even as much as 10?
Yeah, it opened up in 2012.
Okay, 10 years.
About 10 years. Yeah.
That's
And
yeah.
even before that, if you knew somebody, you could, but 506C was not as much of a thing. Like now, there's, this is all regulated by the SEC. And you're actually using to be able, so because to do these properties, you're considered, because you have to raise this capital to be able to put into these properties. So to raise capital, you are under SEC guidelines. And so if you don't want to have like a security license, kind of like, hedge fund managers, you have to, you go by these, it's called Reg D, it's a regulation through the SEC. So either it's a 506B or a 506C. So 506B is you can only bring in investors that you know and have a relationship with. 506C is where you can advertise, and that's the stuff you see in Facebook ads and things like that. You can advertise and bring in anybody. With 506B, you can bring in people that are not accredited if you know them. So not accredited, as in, the net worth doesn't have to be over $1 million. Their income doesn't have to be over 200. So you have a certain amount of they call sophisticated investors that you can bring in. So some people will do that because you can bring in friends and family that may not be accredited. For a 506C, everybody has to be accredited. And this is basically the SEC's way of just protecting the public. So because you should really understand what you're getting yourself into, because, there's risk to any investment, right? And so people need to understand the risk of it before they invest.
Thank you for defining accredited investor, because a lot of people don't know, and they don't know they need to have
CPA letter and stuff. Yeah,
they have to have an income of 200,000 or greater for the last 2 years, or 300,000 for a couple for the last 2 years, or $1 million net worth, not including their home. But what are the consequences if somebody in a 506C takes in people who are not accredited, and what would the SEC do to them?
Yeah, well, you can go to jail.
That's what I was thinking. Okay.
Yeah, it's pretty, it's very, very highly regulated. So, if, and they've been auditing. In fact, everybody knows Grant Cardone. So he got in trouble for that. Yeah.
Okay.
So he had some issues that happened. So, so people were getting a little bit lax, and then people started getting audited.
Okay.
So in fact, you have to keep a log of when you've met somebody. So when I have people, go onto my website and sign up for the investor club, I actually put them in a separate area, because I have to have talked to them and then know them for a certain period of time before they can even get any of my 506B deals.
Mm-hmm.
You have to show relationship.
So, I think that's a great opportunity for the people who doesn't meet that accredited investor opportunity to invest, because a lot of people kind of get scared away because, oh, I don't have $1 million asset. I don't have that income, whatnot, and I don't have enough money to invest. And then they just kind of quit. And, I see a lot of posting, people encourage, just go talk to the investors. Sometimes they have a deal they don't advertise, because some of the deals you cannot advertise. So that's a great way to get started, actually.
Yeah, it is.
Yeah.
And I think, I encourage, whoever's, watches this and is listening, just, you can sign into my investor club or others, like, just get the deals, look at them, learn to understand them. Like, you don't have to jump on it. You look at them, ask questions. That's how you learn. I mean, that's how I learned at the beginning, right?
Is there a link so they can maybe schedule a call so they can have it on the books that they actually spoke with you? Because that's what I noticed with other sponsors, that we've got to have a call. And I made the mistake of just talking to Aaron and not his wife. Oh. And Aaron's like, you can't do my deal. And I'm like, okay, fine. I'll talk to you. I'm talking to you forever. So
because now he's he's doing family offices and stuff, so they both have to be So again, that's SEC guidelines. So if you go on my website, there is a link, a calendar.
I'll post it in the email, and I also post in the posting in the our group. I was just looking at I was just looking at your website, because my other question for the audience is where to get started, but you actually have a start learning. So visit your website and look at the the blogs or materials and then sign up for your service and have a conversation. Actually, for me, what helped me is like interviewing a couple of different syndicators. And when I kind of have to prepare myself, what kind of questions to ask. So I kind of dig through and study certain things because I don't want to sound like I not know anything. I need to know something. I think that's how I learned.
I think the more you do, the more natural it becomes.
Yes.
It's like
Yes.
doing an H&P. If
Yeah.
you can do
Exactly.
H&P,
Good analogy. That's a great analogy. Yeah.
because,
No,
in the
it is.
Like, oh, did I forget review systems?
Yeah.
But
Yes, I totally agree with that. The more you see, the better off you are. So,
Right.
and like feel free to book a call anytime with any questions, even if you're like years away from investing. It doesn't matter. It's just a way for you to understand what all the different vehicles are. And with me, even if people are interested in short-term rentals or midterm rentals, single family, if you have any questions, just feel free to,
Can I ask, since you're a general sponsor or also known as syndicator,
yes.
with the changing market, the rising interest rates, and the vacancies in like commercial, I know multifamily is still a very safe bet, but are you still doing some of your own private investing in commercial or other industrial stuff?
I'm gonna wait and see. I'm not doing industrial right now.
Okay.
With the recession coming, I think apartment complexes do fine during recessions if you look at it historically. But when you look at industrial, right now industrial is still super strong. The numbers are really good, but I can see it becoming an issue. So yeah, as time goes on. So I am kind of holding off right now unless something really great comes up. I'm going to wait. I have a couple of friends who do a lot of triple net. And even that I'm kind of hedging on right now. So I'm going to wait and see. I'm going to continue investing in apartments.
Since you're doing a lot of stuff in Houston, are there specific things like the flood insurance and things you pay attention to when you're doing your underwriting?
Yes. So in Texas, every area has its own issues that you kind of have to worry about. So Sujit and I were talking about earlier is, my short-term rental properties are in on the coast here in Carmel, and it's hard for me to get insurance. Like the past 3 years, each insurance company has pulled out, and I've had to find a new insurance company.
Because of flooding or something, or
because of fire.
Oh, fire. Okay.
Yes. Yeah. And so in Houston, it's flood. Yeah. So both the Houston properties, literally up until 2 weeks before closing, we were still bargaining with the insurance company because the biggest cost is one of the biggest things is insurance and taxes. Those are the two biggest things in Texas, and you have to underwrite for taxes.
Right? The taxes.
Property taxes are very, very huge there. So because there's no state tax, but they're going to get you some way. So
no, I remember that about Texas.
Yeah. So you are actually underwriting for a higher property tax pretty much every year. And so in Texas, you actually have to go and protest every year. So like this year, we'll be protesting the taxes on our multifamily.
Wow.
That's what I heard from CAF, because they're in Frisco, Texas. I think they're moving offices, but they were saying they have to protest. And I think Post in Beverly Hills was saying the same thing. They need to protest, but they had cut some deals with like Houston Housing Authority to forego taxes on the deals that they've done. And they were doing some Corpus Christi deal too with the Housing Authority to forego
scary place. Yeah. It's the insurance there is crazy because it's so high risk.
That's a lot of water, right?
Yes. Corpus Christi has had a lot of damage in the past. So and almost the entire thing is a flood zone. So the insurance is very, very high there. Yeah.
Wait, so this is really good. I was listening to, throughout the whole presentation. I think I had one question. When you talk about you need to know the market, and a lot of beginner investors don't know where to go find these market. Where is a good market? Do you have any resources that you recommend for the people, because all the syndicators, they will say this is a great market,
Yeah.
right? Yeah, but as an
Yeah, so-
investor,
So, CBRE, which is a commercial brokerage site, sometimes they have some articles that you can get for free. And usually one of the articles is about market analysis. CoStar, usually end up having to pay for, but sometimes they'll send out stuff that's free.
I see.
Yeah, right now, the biggest markets, like I said, Texas, Florida, and like in Texas, it's basically Houston, Austin, Dallas. San Antonio used to be good. It's so right now, not as much job growth there.
Yeah, I noticed you didn't mention them with the other three.
Mhm.
What about Georgia? A lot of people were doing.
Atlanta is great.
Okay.
Atlanta is great. Phoenix is really good right now. Tucson in Arizona is also projected to be within the top 10 in next year. And Nashville, Charlotte, North Carolina, Greenville, South Carolina, Tampa, and Orlando and Miami. Although Miami is just so expensive right now, it's hard to justify.
Mm.
All right.
Jacksonville was really high before, but now again, even there, the job growth has kind of flattened and rent growth has flattened, so not as good.
See, those are the things that the beginner investors don't know where to get the information. So it's kind of, you just mentioned about some of the big company moving to certain areas, whatnot. We're not aware of it. So I think that's a good place to get started. Judy has a question. Judy, can you unmute?
Sorry, there.
There you go.
I have a comment.
Yeah.
In addition to the markets, one really important thing to consider, I mean, not so much maybe for syndication, but it's probably still, is renters' rights in those states, cities and towns. Because some places, yes, you'll have issues with squatters, or if you're in the north, you can't evict people in the winter. You can't, there's just so many can'ts. So you got to know all of those things, because if you're giving free rent for 6 months before you can kick someone out, that's gonna, cut your margin. So something to consider too.
Yeah, it's the biggest reason why I sold my California properties.
Yeah.
I had a property in LA, 6 months it took me to get the tenant out.
Yeah, evictions are really hard, and then you just have, and then I'm assuming that there's legal with all of these syndications. Like, do you have an actual law company? Like, usually you have management company with a lawyer that takes care of all of that. Like, I have a place in Vegas, and it's like, if you're late, 72 hours, you're served papers and you're getting evicted.
Yes. Yeah,
So-
we have lawyers that we work with very closely. I mean, first of all, we have lawyers that we work very closely. Even we have an SEC lawyer, but then we also have the property lawyer. So
Yeah.
All right, it's already like almost 5:30.
Okay.
The presentation, it's so interesting because Kathy and Judy and I are a little bit in the area. Well, Kathy and Judy probably a lot in the area. For syndication, I'm like at the shore of it. So the conversation is more interesting, and there's a lot I can learn.
Well, I've never actually done a syndication. I've just
Judy?
done single
Judy does
family.
active.
I'm sorry?
Judy does active real estate.
I see.
But not very. That's what a management company
the in
for.
between,
So instead of a general contractor, I have a management company.
I see.
Perfect.
Good,
Yeah.
good. But I think this is a great talk. If anyone has any questions, I will post her website and you can reach out, and emails her too. So in the email, and then also I'll post in the website so that people can reach out to you. Thank you so much. It's been very helpful, and I hope some people reach out to her, reach out to Dr. Mitroo, and then get learning and get started. This is a great, I think it's an alternative for diversification. I think this is a great investment vehicle. Yes.
Yeah, it's great to diversify. And, if you want to do something that's completely passive, it's a great way. Just make sure, you educate yourself. It's really important. And that's one of the reasons why I even built the website, because I think it's so important to have something like the education part of it. So
I'm just impressed you have time to do everything you do, Pradnya. To sleep,
She's been doing this since 2005. It's not overnight.
Yeah, you know,
Husband
it keeps me
started.
going. So yeah,
You're
yeah.
also
And
the managing partner too.
I'm sorry.
You're the
Oh, yeah.
managing partner too. You're not
That's-
just Doc. You're
Yeah. In fact, next week we are starting our new joint venture with the hospital for a new endoscopy center. So we're working on that.
Oh my God. That's another whole business itself.
Yeah. Yeah, I don't see.
Wow.
All right.
So yeah,
Well,
you know what? The best thing about this is, you know, I mean, I love medicine and I want to keep loving medicine. And so this way, you know, I can work as much as I want. I could still stay with my autonomy. Like next week, you know, if I have something for my kids, I can say, I'm going to move my patients and, you know, and it's okay. I don't have to worry about it. And so it's allowed me to do that.
I think that's the best part of having this other business. I mean, there's some values and meanings that you get, but the other part of it is make the medicine much.
More fun.
I know, or you're not afraid. Like, you know,
Yeah, it makes medicine much more fun.
yeah, if they throw some BS, I'm like, oh, I'm not going to deal with this. I don't have to do this. I can do it in a different way. I think that's the biggest beauty of having other
Passive income streams. Yep.
Yes.
Very, very important. Yeah.
It's that freedom to say no.
Mhm.
Exactly.
Exactly.
That's priceless. Yeah.
Yep.
All right. Okay. Thank you, everybody. Thanks for joining. Yeah, I'll see you around.
Thanks for
Meet
sharing
up
this,
again
thanks,
in Southern
Pradnya,
California.
for-
All right.
Next
Thank you.
Prandya.